Hello traders, it's Thursday, March the 6th. This is John Kicklighter, Chief Strategist for DailyFX.com. Here to give you your FX market wrap-up for this past 24 hours of trading and an outlook for what we can expect in the coming 24 hours ahead. This past session was one of volatility. The coming one is certainly going to be one of volatility, and even Friday's session is likely to be marked by volatility. Why? Because we are following not those major trends and themes that we've been so desperately seeking out, like risk-based appetite. We're looking more at catalysts, short-term, definable, discrete, very certain to give us some kind of surprise. And that event risk is certainly proving its weight in gold. Now, in the coming 24 hours, top concern is going to be the euro and the euro-based pairs. These pairs are not just exploited by and sensitive to the ECB rate decision, which is going to be key event risk. They're also in great position for technical moves. All right, so we have congestion. We have markets that are certainly prone to breakout and paying attention to monetary policy, so as market conditions. And then we also have the fundamental event risk that can play the catalyst. All right, so something like the Euro USD we've been talking about this multi-year wedge formation within this 2-year wedge formation, something that can give us a definable short-term breakout, maybe even a critical breakout if we have something of substance. But this is something that we can really look for. And if we don't want to go full scale, because that's actually quite difficult to achieve, getting let's say a break above 138.50 or really diving below 135, that is a very tall order, even for event risk of this magnitude. We still have great short-term potential, like this is a 4-hour chart of the euro pound, much bigger wedge formation here, descending channel, but this shorter time frame wedge pattern, this breakout, is a much higher probability. Similar circumstances for the euro yen. And even getting something like the Euro Kiwi, which is at immediate support and playing within a range, something much more feasible. But these Euro pairs offer us great potential. We'll talk about the ECB rate decision and its possibilities briefly, because I did cover it in depth in today's strategy video, but we'll cover it in just a second. But before we get there, we need to look at how the markets have developed in the past 24 hours. How have we developed for risk trends? Well, risk was pretty consistent. We have the S&P 500 here representing the backdrop for sentiment. You can see it was an up day, but not by any magnitude scale. This was really, really restrained. The daily range was extraordinarily small, and we had little to no follow-through. And this wasn't just a consideration or a measure on the S&P 500 or even just U.S. equities, although you see the Dow Jones Industrial Average here gave us little to nothing as well. Similar circumstances in the Asia equity markets, Nikkei 225. This thing is really struggling with 15,050. It really does not want to generate that follow-through. The German-based DAX, right, FTSE 100 UK, FTSE MIB, all right, these indexes are not generating strong follow-through. The same situation in other assets that are risk sensitive as well. One noteworthy push came from the pound yen. That trend line was nudged over. But we're not clearing it with gusto. Remember, it's not about the breakout, it's about the follow-through. And we haven't had a lot of follow-through here. Euro yen still holds. All right. Dollar yen, realistically speaking, isn't even testing its own respective range resistance. That's up here at 102.70, 102.75. Still a ways off. We also have the Aussie yen actually testing major trend line resistance here. This was helped along up to this level. It was trading about 50 pips lower until we had a very strong Aussie round of data. We'll talk about that in a second as well. But here too, you see the lack of conviction. Kiwi yen was one of the standouts. Like the pound yen, it moves, it makes the break, but the follow through is what we're really looking at. Now, what was giving risk trends its positive lean, yet lack of momentum? we had a number of specific indicators, specific pieces of event risk that we were paying attention to, and it has a questionable influence on our progress. The Chinese National People's Congress began with opening remarks from the Premier and the Finance Minister and the Chairman for the NDRC, and they gave GDP forecast for 2014, 7.5%. This is essentially a little bit slower than what we had previously, but at the same time, it also suggests that they're not going to back off of their credit explosion. All right, and they've vowed to reform their credit markets, to curb pollution, trying to make this a more sustainable long-run growth factor. But they've eased back for the shorter-term fulfillment. All right, so this is actually a positive lean for risk trends. Longer term, a questionable situation, but as you see right now, it keeps the conditions and supports the conditions that we've really been running on here with risk. Now, we've also had a couple other indicators, the ADP figures and these survey sector ISM number for February. Both these indicators are disappointing. Notably, the employment figure here from the service sector report. Service sector jobs actually account for most of the jobs in the United States. Both of these disappointing on an employment backdrop. All right, we won't cover non-farm payrolls until tomorrow in the strategy video, but this is a very disappointing outcome. All right, now this has a interesting implication. From one perspective, a lot of people would presume that, hey, this is a disappointing outcome. The data would suggest that we are more likely to go back to the taper. All right, that the Fed would second guess its taper, and subsequently we would expect the Fed to ease back on its reduction in stimulus. But as we've heard repeatedly by the Federal Reserve and its individual members, it is a very high threshold to turn them away from the taper. All right, they're going to taper unless their forecast for growth significantly change. That's something that Janet Yellen, the Fed chairman now, or chairwoman now, has said explicitly. All right, this is a reality of the situation. They're willing to tolerate growth slowing as long as it doesn't substantially change their economic forecasts and their inflation forecasts. And more importantly, we've also heard from a number of officials, not just Dallas Fed President Fisher, who has been the champion of this, but he has warned that they wouldn't be put off taper even if there was a substantial market correction. All right, that should unnerve a number of investors. These are conditions that are reflected in the market, not really supportive of strong economic growth. They're not supportive of the expectations for growth or yields or capital moving from one end of the pool to the other, the velocity of money. These factors are not supporting the conditions we currently have. We're at record highs on things like equity indexes. We're at record highs on other high-yield, high-risk assets because investors are trying to exploit whatever opportunity they can in this irrational exuberance. All right? We see this in leverage. We see this in exceptionally low levels of participation, 15-year low in open interest for the S&P big futures. All right, we see this in exposure to riskier assets, whether we're talking about high yield or we're talking about emerging markets. We see exposure to these assets and to this level or this style of life where we know it's not sustainable and we know it does not match what the expectations are, the forecasts are, but investors are willing to continue to feed it because it is the prevailing trend. All right, this is a dangerous circumstance to be living under. All right, this is a dangerous situation to drive these markets forward, in which we're just trying to see the markets sell volatility jumps. All right, so quick corrections in the market, they're generating the most activity. We get the most volume around these quick pullbacks. Traders quickly run in trying to force it back up. Now the follow-through has been very restrained, but that initial move is where you see most of the interest. When we flip this upside down, the volatility index, we see just how it plays out. This is a short-term interest in these markets, not a buy and hold interest in the markets. You're not getting new, fresh waves of capital to keep a long-term trend hope alive. You're just seeing investors taking advantage of those short-term pullbacks. Investors taking advantage of quick drives in the market, driven higher by volatility events, driven higher by the opportunity to short, as we call it, short vol. As we talked about in yesterday's strategy video, this is not a sustainable circumstance, and it will eventually come crashing down. These are conditions that we've built up that are very fragile, and they certainly ramp up the exposure that these markets have. But the question is not if, it's when. And when also means that if we get in too early, we expose ourselves to being on the wrong side of a market that is simply complacent and is dead set in trying to take advantage while they can. So fighting these risk themes is proving a very risky venture. I know a lot of people are trying to do it, but at the very least, wait till you see something that breaks down. Wait till you see the benchmarks like the S&P 500 take a move to the downside. Wait till you see some of the yen crosses, the key yen crosses, make a dive. Right? And your best bet is when you actually see the technical breaks accompanied by the fundamental drive that says risk off. Not just a indicator signaling it, but seeing many different indicators confirming that move, and the sentiment starting to become more prevalent and pervasive amongst the headlines and internal trading discussions. All right, so we keep a very close eye on these risk themes. They are our number one concern on a day-to-day basis, and this is why we've always talked about the volatility measures, why we talk about the relationships and correlation, it's why we talk about this risk sensitivity curve. In this risk-positive drive. So let's strip out the risk aversion and say risk positive, or risk appetite. Emerging markets are rising, yen crosses are rising second consecutive day, equity indexes are rising. Dollar is not really responding as a safe haven, so it's not dropping aggressively. Pound dollar is not rising aggressively. Euro dollar is not rising aggressively. Treasuries and sovereign assets are not being treated as a safe haven that we just need to ditch at all costs. All right, so the volume is still medium on the curve, but the conviction is still exceptionally low. That's been the problem with risk on. It does not generate traction. It does not get follow through, and this is something that we must appreciate when we try to position for these kind of setups. Right. Now this morning we're seeing some volatility. As I said, the yen crosses have seen a consecutive day rise. We're getting a little bit more strength through the early Thursday morning session. This pound yen move, though, you have to take moves like this and put it into context. A pound yen move all by itself is not going to be a very good setup. Why? Because you need to have follow through. You need to have that drive that actually makes the break into a short-term trend. All right. And if we don't get something along the lines of, let's say, a Aussie yen break, or a Kiwi yen break and follow through, or a Euro yen break and follow through, it's not going to be a very high probability circumstance. Now with the Euro yen, you could get a break, but that's going to be on the ECB rate decision. With the Aussie yen, if we do get a break, that is probably going to be more related to what we just had in the Aussie data this morning. All right. If you really want to see for a breakout that has follow through, even on some of these yen crosses that have an alternative catalyst, it's going to be very difficult for the yen crosses to deviate from their relationship to risk trends, so it's best to actually find risk trends and follow that as your primary driver. That means watching the Nikkei 225. The correlation between the Nikkei 225 and the yen crosses is exceptionally strong. So where that index goes, the yen crosses typically follow. They reflect the same general circumstance. When we want higher rates of return in a standard portfolio, we go to equities. Right, that boosts the Nikkei 225. When we want a higher rate of return in the FX world, we go with long carry. Not only do we get the capital appreciation that we associate with risk on, we also get the carry, the rollover, which is actually the initial appeal for many of the long-term holders, buy-in holders. All right, so if we want to see those yen crosses make breaks, don't rely on the individual economic indicators. You can play a fundamental break with a little bit of follow-through, but it's not going to come from that theme alone. And we don't like individual standouts. We have to see this as a general sustainable trend, and that's going to come from this relationship here. And as you can tell, I'm a bit dubious on what we can establish through risk on, whether through the Nikkei 225 or the S&P 500 and its relatively restrained circumstances. Now, risk trends and the U.S. dollar, we'll be paying attention to the non-farm payrolls we have coming up. The past session we had the ADP report and the ISM service sector survey, both disappointing. In the upcoming 24 hours, we have a range of Fed commentators. We've already had Fisher talking hawkish as expected, Williams, all right, Dudley, and we come into Plosser and Lockhart later on in the day. All of them are going to give us some update, but is it necessarily that market moving? No. We know where they stand. We know their general consensus. What's the unknown is the definable data. As given by the central bank itself, they said that the subsequent rate hike, the eventual rate hike, or the decision to curb or maintain taper, data dependent. What data do we care about? Well, absolutely, we care about the U.S. non-farm payrolls and, more importantly, the unemployment rate. That comes on Friday. Knowing that that's ahead, it's going to curb interests in the preceding session. All right, so you manage your expectations, whether you're talking about the S&P 500 or whether you're talking about the U.S. dollar. All right. Now, as I said, we had a lot of volatility in the Aussie dollar this morning. You have this big jump from the Aussie USD. All right. You had, and I'm most interested in this Aussie yen move. This has moved us right back up to that meaningful trend line, that multi-month trend line here, and we'll see if it stalls. But if risk trends are going to pay attention to Friday's non-farm payrolls and not make much progress, if the Aussie dollar's move that we just recently had this morning has been driven on short-term factors and is not going to find strong follow-through. And what were the short-term factors? The trade balance had its biggest move since late October, or it has the biggest surplus since late October, and the retail sales had the biggest jump since February of 2013. So that's a good combination of data. It does give the Aussie dollar something to chew on, and certainly has given the a big jump to the crosses. So Aussie yen, Aussie USD, Euro Aussies drop down, Pound Aussies drop down, but both of these pairs, they're really looking at the bigger picture head and shoulders patterns here after these long trends. All right, I'll be watching these, especially the Euro Aussie at 150, but those are going to be a little bit further than what we should expect. We should really be paying attention to those pairs that have immediate technical interests, like Aussie Yen or Aussie CAD, maybe even Aussie Kiwi, which has moved back up. All right, those are going to have better potential in this data. All right, but that data is probably going to be relatively short-lived as we're paying attention to bigger themes. Of course, top interest, next 24 hours, ECB rate decision. This is going to be coming out at 12:45 GMT. President Draghi is going to be talking at 13:30. All right. My scenario table is pretty straightforward. Likelihood of no change in policy, which would be bullish euro, which is one of the few outcomes which would be bullish, although it's not going to likely be strong bullish, and bearish for European capital markets. All right. This is a pretty good probability, but it does introduce more problems later down the line. The IMF even warned the ECB that they should do a rate cut as well as either a stimulus increase or they should do a LTRO upgrade. All right. Now the alternatives are that they stop the sterilization of the bond purchases that they've had, the sovereign debt. I think that that is a pretty good probability as well. Definitely bearish euro, but not strong bearish euro. That's the lowest they can do on the scale of stimulus and support. A rate cut won't likely give them much in terms of long-term economic and financial influence, but it certainly would be bearish for the euro and bullish for the capital markets, and really a new stimulus target or a new stimulus upgrade or LTRO program, lower probability, biggest ultimate impact. We should not expect the biggest ultimate impact. Have a scenario for it, but don't expect it. All right, expect something that's more probable. One of these two. All right, if the outcome is euro long, all right, so we have a hold in policy and we don't undermine interest rates and the interest rate forecasts that these supply, I'm going to be looking at the euro kiwi. All right, good potential here at the very important range low, and moving within a range is low requirement. It doesn't require a breakout. And a no change in policy doesn't give us that big change in positioning. Alternatively, if there is a outcome that is euro bearish, right, and if it's a moderate euro bearish, so the sterilization, stopping the sterilization, then I'm going to be looking at euro pairs that are relatively overbought. All right, so where the euro can get a move to the downside. If you're looking at a range-based move, something like a euro yen is a good position to do so. If you're looking at something that's a little bit more aggressive for follow-through, which is still within a range, euro dollar. Great. It looks great at 138.50. That's a heavy support. Respecting that move and moving back down towards the bottom of this rising trend line here, that could be a good possibility. But if things really get hot, if you get a really big risk aversion move, keep an eye on euro dollar, breaking potentially 136. Keep an eye on euro pound, short-term breakout, but also a long-term breakout. Take a look at euro yen. Most of these euro crosses have great potential. This is definitely a piece of event risk that has a significant opportunity to generate volatility, and that's what we look for. But this volatility has to be put in context of reasonable trades. We don't want to just look for volatility because that is not even the minimum requirement of setting up a trade. We have to have a plan ready to go, and that volatility has to be given a clear direction, whether it be a breakout, whether it be a range, and we have many options and opportunities depending on what the outcome is. All right. If you want to learn more about that, check out the strategy video. There's going to be likely a lot of volatility in the next 48 hours, so be prepared to trade and trade on the time frame these event risks demand, and that is definitely in the shorter term. Good luck trading out there, guys, and I'll update you once again on these markets tomorrow.